The CPI reports came out yesterday, which is a measure of the average change in price paid by consumers. And the result of those reports showed that inflation was still up, but it's coming down. At the peak of inflation earlier this year, we were at 8.8%. The Feds quickly started raising the Fed funds rates, and mortgage rates jumped up over 7%. Now, yesterday, inflation came in at 7.1%, showing the effects of the Fed's moves throughout this year. And the markets reacted favorably, and we saw some nice downward movement with the mortgage rates. Now, today, the Fed announced their half-a-point rate hike, which was expected and was down by 0.25% from previous month. These numbers were already worked into the mortgage rates. Now, the Fed also published their quarterly dot plot, which shows projections by each Fed policymaker for the Fed funds rates for the coming years. And in this report, the median dots were actually a tad higher than previously reported. And since then, bonds have reacted negatively to this. So we're going to follow along this week to see how this shakes out. But looking at the big picture, we're super happy where rates have been. They're much lower than our peak pricing earlier this year, with the majority of our clients obtaining rates in the 5% range on their purchase and refinance loan.